S&P 500 had its first higher high close of the week on Friday after a gap fill. We can see that right there. But we're seeing the rotation, and we're going to explain why we're still seeing this rotation. I think it's really important to go through a couple things specifically. I think it's really important to understand is, are we going to hold this level, and what do we need to look at to see if we even have a shot at holding this level? You have a huge earnings week right now. Smart money, dumb money, we've gone over ad nauseum, and we're aware of where we stand there. But does this have a shot at holding, and what should we be looking at? For example, if we look at this cloud, the Ichimoku cloud, you can see how we've popped back in that cloud. What's going to get us back over that? If you're ever in this cloud, think of it as quicksand, and you can always see how that cloud is getting wider and wider. This is something that we have to focus on, and we also have to think about it from the perspective of this. Is this the new area? Is this what we have to be focused on? What about this flag that's forming going into the Fed meeting on July 31st? There's a lot of moving parts right now, but it's important to understand how the heck did we even get here? So let's get into it. There are two major shifts that took place. It's important we understand these shifts and we understand how they happened, because going forward, these are what's going to rule the rest of the year. It's very simple. But we have this date on July 11th, and we're going to get to why that date is so important and what happened on that date. But from that date on, if you take a look at that zero line, you will note that the SPY is here, and this is the S&P 500 market weight, meaning that every stock market cap is determining what the S&P 500 is. This is RSP. And this is equal weight. And that takes all 500 names and gives them the same exact weight. Now you will note from this point on, you have a clear demarcation. From this point on, you are down 2.8% and you are up 2.95% from that date. You can see the change. You can actually see the change in the market between when we started to drop, level off, the drop lower that took us out here on the market weight side, but did not take us out on the equal weight side. And then you can see how the lower low never took us out. And this is really important to get, and we're going to get into why this is. But just remember July 11th, and then we're going to talk about the significance of this and how it should affect your trading towards the end of the year. These are big shifts, and I've been waiting to talk about it for some time to get all the data together to connect the dots. And also, this is also leading into the big buybacks that are about to start. Now, in front of us is the IWM, which is the Russell 2000, RSP, which is the equal weight S&P 500. Then we have the market weight by actual market cap that we're all familiar with, and the NASDAQ. And we have the same exact date here, which is this July 11th date. And we're going to get into why this is very important in a second here, but I want you to get the premise on what's happened since this date, and then I want you to look at the changes in the market from that zero line coming straight across. There are two that are up, and there are two that are down. NASDAQ is really still struggling. And if we take a moment and do a deep dive here into about 42 sectors, I took the 42 major sectors, and I will have this available for people if they want to just take a look at themselves so they can go through this. And what I want to show you before I get there is, this is July 11th, and you can see exactly a huge shift that happened on July 11th. Now, if we go to that date, and we start getting tighter, you can see that shift taking place. It is a massive shift where they are dumping certain names and they are buying other names. So if we go back there to that specific time, you are going to see that regionals, home construction, home builders, small caps, oil names, and biotech, REITs are on fire. They are the new leaders. They are your new tech. We're going to explain now why this started, when it started, what you have to watch to see if it's going to continue, and then we're also going to discuss the probability of this continuing, and we're going to tie this all together. Today we had two pieces of information, and the time of recording this is Friday the 26th, and what we saw that core PCE actually came out higher than expected, but personal income was down. This is very important to tie in. And then we were looking for the consensus, but personal income was down, but spending stayed the same. Now, this is really important to get. If you have personal income dropping, but spending is not changing, then eventually you're going to have a problem. You can't spend more than you're making. And if you're not increasing here, but your spending is increasing, it's an issue. And core PCE, which is ex food and energy, did not drop. It went up, which means things are getting more expensive. That's what this is all telling you, which is bad for the consumer. We're going to get to the Michigan consumer sentiment in a second here. But this is really a very important concept to get, and it was very confusing data when it came out. And this ties directly to what we saw on July 11th. Now, this graph is going to highlight one key thing for us. This is the Michigan consumer sentiment, and it declined 2.2 to 66. This is where you started at 80. You're right here for 24. And this is what's been happening ever since. And what this is telling us is how do consumers feel about the market? We've all seen these consumer stocks and we've all seen them getting pummeled lately. We'll see some of those later in the day when we talk about them. We've all seen Ford, Lulu, we were all watching these blow-ups. But this is what's happening. As a matter of fact, there was actually a statement by Nestle today where they came out and said that even the lower end consumer is starting to be price sensitive. So as this declines and prices don't move, you start to get into a period here where things just can't go up in price. And that's an important distinction. Not that prices aren't increasing, but things can no longer go up in price to the consumer. And that's going to segue us right into our July 11th date. So right here, you have the United States inflation, or CPI, month over month, and you are at a negative 0.1. Now, why that might not seem like a lot, you were looking for 0.1. And what happened was PPI actually came out hotter. Now, PPI is up, so producers are paying more. CPI is down because the consumer can no longer pay more. They can't afford it. And we saw this across the board. We'll get into a couple examples here. But what's really important about this is they can't pass that along. That affects corporate profits, and it affects the gross margins, which of course affects corporate profits. Coming to that little line, what you're seeing here is you're like, oh, we've done that before. We've done that before when we're expecting it. We were not expecting it. Matter of fact, you can see the last time was the great financial crisis, and you do have blips here, so it's not like it's that big of an anomaly. Here's the great financial crisis and COVID. It's not like it's that big of an anomaly, but when you're waiting for a positive number and you come out negative, and that PPI doesn't drop with it, and that PPI is actually going up, it's an issue. Now, for context, what we're going to look at here is just the PPI. Producers, what do they pay to manufacture the goods? Think of PPI as they go out and buy the ground beef that goes in your burrito. They make the burrito, and then they can charge a certain amount for it. You can see from here over, from 24 over, that now that they've been passing that along, we're hitting a point where they can no longer pass that along. Now, on top, what I'm going to show you is the year over year, and you can see why the month was so significant. But now I'm going to show you the year over year, and I'm going to compare the CPI year over year to the PPI year over. And you're going to notice some disparities, of course. You're going to notice what happened in 2020 right here. Okay, and here's 2020 as well. We fall off a cliff, and you can see how that goes. And then you can see here as well. And what's important about this is really just right here. And what I want to do is just focus on 2024 and how we're rising there and how we're dropping here. Now, all I have to do is just mark this little guy over, and you can see how PPI is going up, which is on the bottom, and CPI is going down. And now what's happened is you've hit an inflection point where the consumer can no longer afford to have those costs pass through. Hence, CPI month over month went negative, and now you're starting to see that reflective in the gross margins of corporations. It's why we saw what happened on July 11th happen. Let's talk about how this is going to affect the bond market so you know what to look for. We're going to look at other scenarios where this has happened in the past and what the outcome of it is. Let's start with the basics. This is the target rate probability for rate cuts. This is September. July is next week. July is predicted to be a non-event. This is our target area where we currently are. This is showing you less than the target. Now, what this will show you up here, the easy way to read this is the chance of an ease in September is now 100%. Just to put this in perspective, what's really great about this, and anyone can look at this, it's CME Fed Tool. You just type it into your system, Google it, and you'll find it. But this is really important because they do a great job here. 1 month ago, there was a 56% chance. You're now at a 100% chance because you take the 87, and then there's now an 11.9% chance of 2, and there is a 0.4% chance of 3. That's how drastically things have shifted over the past couple weeks. And I think that this is lost on a lot of people because they don't spend time on the macro. If you watch this for some time, you know that I'm very big on explaining the stool to people, where we have the macro leg of a stool, we have the fundamental leg, and we have the technical leg, and then it all sits up here. And then there are times where you're going to be weighted here, or weighted here, depending on how you lean on the stool. But to just look at the technicals and tell you what's going on is going to put you at a huge disadvantage here. You have to understand the macro shift here, because once you understand that, you're going to know where the money's going. And now you're going to understand why the money's going there. And I'm going to explain that in even greater detail. But this is really significant to get, because if we know that this is where we're going, and we know there's a 100% chance of a rate cut, then that alone allows us to know what sectors we should look for. And if you don't understand that, I would strongly suggest that you start looking into fundamental analysis a little bit more. But let's go through this just to the end of the year. And what we're going to do is we're going to look at November now. And to me, this is where it gets kind of interesting. I think it does. But all right, so there's a 28% chance that you're here in November. which is basically telling you that they don't think you're here. They're telling you you're getting another rate cut, 63% chance. They're telling you that they're going to cut. There's a 100% chance of them cutting in November 7th, and there's an 8% chance right now of 2 cuts. So if you went and took a look at this and said, okay, well, we know that 50% is here because of this, and we know that that's already happening. So they're saying that there's very little chance of that continuing. But if you go and say, well, we were at 23% of being down 2 rate cuts by this time. We're now at 63% chance, and we went from a 2% chance of 3 rate cuts by then to an 8% chance. This is not a small move. This is a very big move. And if you look at it and you go out to December, let's blow this up and look at December for a second. And now you're out to another 100% chance. There's only a 30% chance you're here, and 31.3, and there's a 58% chance that you're here. So again, if you go take a look here and go, okay, 450 to 475, look where you are right now. And so what they're saying in the 450 end to 550 end, they're saying by December, you could have 100 basis points in cuts. That's what that's telling you. That's a probability. And they're telling you that there's a 58.5% probability that you're in there. If you look a month ago, it was 17%. That is because of what happened on July 11th, and then how the other data is coming out to substantiate that. And now you're seeing that again. I'm going to hammer this point home to you. PPI is going up. So it's not like prices are not going up. It's that the consumer can no longer afford it. And we also saw that reflective on Friday, because you're going to wonder, why did you see the continuation on Friday's market? Why did that continue? Because the consumer can no longer afford it. You cannot have income drop and that personal spending is still going up, and then the price of those is still going up, and you already know that they can't afford it because of CPI being negative. So hopefully you can see how this all ties together. It might be something that you might want to watch parts of this a couple times again. But let's get on to what this move actually did to small caps and go from there. One distinction I'd like to make, and I find this very helpful in trying to figure out where I should position myself. There's a couple different ways to do this, but this is US CPI items month over month. I have no affiliation with these guys. This is their website. They do this for free, and they have some other cool free stuff on here. I think it's cool, but maybe I'm a nerd. All right, so here's CPI, and you can see the breakdown. And then what they do is they take each point. Now, I think that this is really important. So here's food and beverage, and you can go, all right, well, 06 to 05, so month over month. So food and beverages versus the previous month. The cost of a food or a beverage when you're out is up. Maybe we should take a look at some of the Monster Energy charts. Maybe we should take a look at CELH or Pepsi and see how that's going. And then we'll talk about why those names are down. And then you would look here at energy and see that energy prices are just collapsing more than anything else. Used cars, which means inventories are going to come down. CVNA, AutoNation are affected by this. Look over here on where you were to used cars. So if you were to look at this graph, what you're able to discern from this is what was affected the most. Well, energy. Energy is being affected the most. Okay, why would energy be affected the most? Well, they can't produce anymore, or they're slowing down production. If you slow down production, then you don't need as much energy. Okay, manufacturing. All right, this could lead to a lot of things like jobless claims, etc. We'll get to that. Not in this video, but again. And then you would go here and go, okay, well, apparel. Well, apparel prices were down and now they're back up again. Okay, so maybe the apparel names are something to look at, and maybe they're finding a spot here where they're getting some pressure where they're able to increase pricing in certain stores. We don't know. We certainly didn't see that yet. And then look at new vehicles and the pricing and their inability to sustain any kind of real stabilization. But most important, when you see changes like this, you want to pay attention. So what you have is this month, you would look and go 0.6, and you're going, oh, okay, so we're up a little bit, and then you go here. That's just telling you there's no market in the market of used cars. The bottom's just literally falling out of it right here. And this is in general, not all used cars, but in general, this is what's happening. And if you take a look at what happened with Ford, if you take a look at what happened with the Mercedes, and they're talking about their gross margins, this all fits the narrative of exactly what I'm explaining to you. And this data was out July 11th. So if you understood how to read this data, you would actually be able to use it to make more informed investing decisions. It's actually on this website and it's free. And I thought that this was a great way to kind of segue into it. But you are seeing some relief. For example, when you see shelter, meaning rents are obviously dropping month over month. Transportation services, there's not a lot you can do there. but medical care is actually coming in, which is good. Recreation prices are going up a little bit. But I think that these are the two main distinctions that I noticed that you can see actually in the market. And I thought it was worth our time to spend on it. This is a piece of research by Goldman Sachs, and I think it really highlights something. If you look here, you have 10. And now look at that 10 in regards to any other time in here since 1985. So this is when people get angry if I put out in the title, not seen for 50 years or 45 years. Once in 45 years. Well, there it is if I put it in the title. Or if the guy that helps me puts it in the title, because let's be real, I don't make those titles fully. Sometimes I play with them, but not really. This is a pretty specific video, guys, and I'm getting into detail so you can understand the inner workings of this. If it's too much detail, please comment below. I do appreciate your comments. It does help me. If you find value in it, share this video. I think that this would really help people understand what's really going on under the hood. But let's stop for a second and just look at that. All right, so that shows the Russell 2000 versus the S&P. Now, why am I showing you this? So you can understand that, but I want to take a second and just give everybody a moment of like, just give yourself some grace. If you're new to trading and you're going to go try to build a metric and process around what happened here, you're going to destroy yourself. This is an outlier. This is an anomaly what just happened. And that's why I'm spending time on it, because this is a massive shift. What just happened with the S&P 500, what's happening when you're seeing with the Russell, even with what you're seeing with risk assets like Bitcoin. This is a massive shift. And we'll get into that in another video, but understand that. If you had a rough week, believe me, this is about as tough as it gets. Now, this is not once in 45 years, but I think this is very important for us to know. And this is Sediment Trader, and this is something that I use them a lot. You'll see that in here. And their source on this data is actually from a Bloomberg. Russell 2000, 5-day percentage rate of change. Russell 2000, 5-day percentage rate of change. Hey, how much did you move in 5 days? Now, I think that this is very, very important, because what this is showing is that we've done this in the past. So I actually have data because we've done this in the past, and they go back pretty far. I can take that data and then they crunch it, and then we can see what happens when this happens. So if the Russell, after 5 days, has a percentage change over that 10 demarcation line, which is a fair double-digit demarcation line, what happens? There's also a way to look at this in comparison to other performance, but we're going to look at this in an absolute sense. So instead of looking at this and saying, let's get into the relativism right now, let's just look at an absolute sense. What do we do when this happens, and how has it worked out? And if you've been following me for some time, you know I'm a numbers junkie and I love this stuff. But here's 12 months and here's a week. And it goes back to 87 from when their data points when this has happened. And I want to point something out. And I want to show you the absolute sense of this. This is 12 months later from the date from whence that happened. Whence? I guess I don't get to use that too often, but there it is. Look at these numbers when you miss 12 months later. So I want to be really clear about this. You're going to note from that time on, you're already up 10%. And from that date, what happens? 27%, 19, 18. And then you have these demarcations that are obviously lower. And then you have these, which you really didn't move a lot. And that's pretty much the great financial crisis. And you can kind of go through here and see when those times are. And I'm not telling you what we're going through right now. I'm telling you where we are. But when you start looking at these numbers that are out here from 09, 011, and you start looking at some of these, you should probably take out some of the pandemic until the end of it. But if you just blend this all together, because obviously we know that we had an injection of capital here of $1.7 trillion. But what we want to do is look at this and blend it all together and see what we come up with. And this is what you came up with. And I think that this is fascinating because the Z-scores, the Z-scores tell you about significance. And you can see that there, Z-scores. This is just fascinating because what it's telling you is 12 months later from the date when that happens, you're up 23%, 91% of the time. So if you were going to toss a coin and you knew that every time you toss that coin, you had a 91% chance of being up, you would do it, right? All right. Then you look at the max loss, the max gain, and then you look at the mean. 23% from the date from when that happened. There are important distinctions here that I want to point out with this data. A week later, you're not doing so great. 2 weeks later, you're doing better, and a month later, you're doing okay. But it starts to pick up steam as what moved it to do that starts to continue. And we know that because we know what triggered July 11th, and we know that this is going to continue. It's why I spent time going through the CME Fed tool and connecting all those dots with the PPI rising and the CPI dropping. Hopefully you can see how it's all connected. Then what you would do is start digging into sectors that are related to those, and then you could see why the RSP is moving and why IWM is moving. You can also take this data and then find sectors that are not going to do well, and then you could actually short those. I'll give you an example. This is from the Nestle conference call. There is value-seeking behavior among consumers. There is pressure, especially in the low income range. Nestle CEO. Now, what's important about this is today we were talking about this, and if you think about it from the standpoint of some guy walks into a Wawa or 7-Eleven, wants to grab a drink, and he's a day laborer. Maybe all of a sudden, if you're working the line, it doesn't matter, union, non-union, if you're working the line, all of a sudden you're just bringing your thermos. You're just bringing something else to drink and you're not picking up that drink. And you're starting to see that across the board. Let's take a look at some of this, but before we do that, I really want to hammer this home. That is why RSP is going up versus the SPY, because of what's going on under the hood on the macro front. That is why the equal weight is going to win out over the market weight right now. That is why we're seeing this underperform and unable to even make a higher high. Please note what happened today. Please note, because time's sake, I'm not going to spend a lot of time on it. Note the higher high on RSP. Note that we did not make a higher high on the SPY. If you go to IWM in the comparison here, note the higher high here at 10 a.m. See it here on RSP? See how you didn't do it on the SPY? See how you didn't do it on the NASDAQ? So if you know that this is what's happening, this tells you where you should be focused on. You should be focused here. You should be focused here. And then you would go over and you would overlay all this. And we can even drop this to a 1. Some of these will be outliers. But we can even drop this to a 1 and then just go look and say, okay, well, where's the money going over the past couple days? Now, if I drop this out to just today, look at the difference in just today and how some of these outliers are starting to show. You can see it very clearly where the money's going. You can also see where the money is not going. One of the questions I keep getting asked a lot about are levels and how you draw levels. Now, you guys will remember this trade, and I just want to show it to you here. So you can see the line, and then I'm going to show you how I got this line. I'm going to show you how we did this with Tesla as well, so that you can figure out how to draw your lines correctly. Because one of the things that I see people not understanding is just because you hit here does not mean that you're going to stop going. This becomes a level of interest. Just like how we stopped here was a level of interest, and I'll show you how that was an actual level of interest. But just because you decided to get to here does not mean you're going to stop. Just because something is support or resistance doesn't mean it's actually support or resistance. You have to start thinking of them as levels of interest. What I tend to do with them is I'll watch them, but I always assume that they're going to fail. Either support's going to give or that resistance is going to give and they're going to break out. By doing that, I'm always buying around there as if they're going to break, meaning expect to lose money on that trade, and then expect this to reject and to lose money. If you go in those expectations, you're never really disappointed. But I wanted to show this because it's something we walked through before, and now I want to show you how I got to these levels, and then I'm going to show you how we were able to do the Tesla trade using the exact same technique. Now, in front of us is Microsoft, and what you can see real clear is this break and where we broke down and nobody wanted the stock anymore. We had that news, what happened with CrowdStrike, it presented an opportunity on weakness. What I'm always looking for are areas of interest where there was a battle. So if you think about a battle, you have both sides of the battle and they're fighting over and over again, and then somebody finally gives up and one guy wins. And it could be that the stock drops or one guy wins and the stock rises. Either way, you have battlegrounds. And if you think about it that way, it starts to make a little more sense. So I always look at those battlegrounds and I always want to look at the edges of those battlegrounds. So in other words, where was there an edge and then where was that edge unable to go any higher? So if you just think about it from a support and resistance level, if I'm looking at a 30-minute, which I just popped up here, and I can't close over that line, I don't use that peak. I use the peak where it was the last one that we could close over. It's splitting hairs, but I find it extremely helpful. And you can see how that became a demarcation place over here as well. So that adds as well. And then, of course, we're going to get to this right now. Now, when this happens, it puts us in a position of, I feel, leadership. In other words, we're already prepped. We're all ready to go. When everyone's panicking in the end of the world, Microsoft's never going to make another operating system, and everything's falling apart, you have your little demarcation line here. And then you just use pattern recognition. This is a pretty simple pattern for everyone they should understand these patterns, but the breakdown, the retest, and then that's it, it's off. That's that 30-minute level, and you hit there. Now, on names like this, what I tend to do is I want to see some follow through. And so I got the follow through, and then we're in. And we're in right around here on this bar, and I've walked through this trade live as well before. But where I'm going with this is, all right, you're ripping, and then what I want to do is I want to look for other battleground areas. And if you think about it like that, it'll just make your life a little easier. So we can see right here, over and over and over again, we stopped. And so when I'm pushing into this, I'm selling. I'm not cheering, we're going to go to the moon. I'm not high-fiving the bros. I'm out, right? I'm pulling money out. Consolidates, pushes. Okay, there's another demarcation line right here. It's a smaller one, but it's there. So now I have to watch that. And if you take that line straight across, you'll see it here as well. So what I'm doing while I'm trading is I'm just assuming these are going to fail. And I just will go on that assumption. So I will sell into them. If you go on the assumption, one, you'll never be disappointed, but two, you'll get positive slippage. And you're going to start hearing me say that a lot. What's become clear from your comments is that I should be going over this stuff and these concepts more than once. People that are educators in the room have told me that as well for a couple years now. And I'm just going to keep hammering these points home and hopefully it'll help you. And then when we got up here, we sold and we got out. Now this is where it gets really interesting. This trade's over, right? We did this trade, we did exceptionally well with it. And what I wanted to show you is if you take those levels that we drew and you start watching those levels over and over again, just by leaving that area of interest, you'll start seeing that they become other areas of interest. So when that area of interest was here with support, see how it's resistance here? And this is what I want to hammer home because I'm going to show you this on Tesla in a second. This is a really important concept. If this is interesting, let me know and I'll do a whole price action video like those other 2 price action videos I did. And I'll link those at the end so you can watch them again. I'm going to do a whole series on them. So if you find them interesting, just maybe subscribe to that or all notifications or just that playlist. Either way, I'm probably going to I have 100 hours of live trading, so I'm just going to keep doing it. But you see how you tested there? And then what do you have? You have a battleground. And this time, I don't know, you can call it the good guys lost and the bad guys won and the stock drops. And so what you're constantly seeing are these become areas of demarcation. So when this rallies up again, do you think that this is an area you'd want to look at? And this plays right into what we're going to talk about with Tesla. So this was Tesla obviously going into the call and everybody was feeling really good about it. And then what happens? It doesn't do so well. And then we get this break of that DTL. And that's why you always have to look when these DTLs, downward trend lines, you always want the confirm move. You always want to get over the higher high, and you just didn't. And it really looked like this was going to be it, but this was really just a dumpster fire floating down the river with a bunch of raccoons. It was really, really bad. So, but let's get to the trade. Now you can see my DTL right here, and you can see that level. Just drew it. Watch when you flip to a 1 minute. Okay. All of a sudden, that becomes a place of interest. So DTL, downward trend lines, you might want to remember this. Downward trend lines can act as support and resistance. And that's a really important concept that most people don't really pay attention to. But the other thing that you should be doing, and I really hammered this home, this is earnings when it just became abundantly clear there's issues on top of issues. So what I always tell people to do is drop an anchored VWAP on the timing of the earnings release, up or down. The moment of that earnings release, you do that because what you're doing is you're tracking all the algorithms, high frequency traders and what they're doing. And then you're tracking all the guys and girls after hours that are trading it, and you're going to get some demarcation lines. What's fascinating about this is you will start to get other support and resistance lines based upon this line. For example, all of a sudden that becomes a place of interest. Why? We reject the after hours earnings VWAP, and that is a rejection. So now we have a battleground and we can see that area right here. Now to clean it up, what we'll do is we'll take off everything and we'll just look at this 1 minute chart. So we know why that's there. That is from the previous level, that is the rejection. And just a side note, guys, when you're dropping on bad news, that is your trend. So this is your trend on the drop. And then you have a counter trend. And it's really important to get this concept because a lot of people are like thinking this is the trend, counter trend. Or I call it contra trend, but I probably shouldn't. I probably should just say, and this is where people get washed out. And it's why I'm focusing on it the more I think about it. They don't understand this is the trend, this is the counter trend, this is the trend, counter trend. You had bad news. Bad news makes stocks go down. Understand that you want to always establish this in your head. And there's a reason for that. Because what people will do is they will go, it's going down, it's going to zero, and they'll start high-fiving the bros. It's going to the moon, they're going to gap fill. Stop telling it what it's going to do. This is the trend, that's the counter trend, that's it. Now, to get back into this trade, and then we're going to watch this live, here's your level. We know how we got that level. That is from the after hours anchored VWAP from the first move of earnings. I can do a whole video on this, guys, if it's helpful. Just let me know that this stuff's helpful, and we'll go from there. When we get to that level that was defined here, that presents an opportunity for us. Okay, and that level does not go away. And I'll show you what I mean by that in a moment. But when this happens, this allows us to put a trade on. Now let's go watch that trade live. Oh, that's good. Now we're up near that level. So let's watch that level. We're there. Now what? So what would you think of doing? What would make the most sense? Couldn't get through that yesterday. You're going to get through it today? 220s. They're already going up in value. They're already up in value. Stock's going higher and the puts are rallying. But the 220 puts, the puts were actually going up in value as the stock was going up. I'll walk through how I saw that later and how I could tell that was happening. If you bought those puts for a trade, I'm in at like 255. They're already $3. I'm just going to pull something out of them in case it goes up and over. So I pulled something out of those. This was so easy. Just leave that on. 350 on the puts, up a full dollar. Pull money out again of those puts in case it reverses, so that if it does rally back up, you're not like, oh, I didn't get out. And then that allows you to leave positions on a little bit longer and kind of go from there. Tesla short, there's nothing for me to do. The best one that's holding up right now is Tesla. But I'm not doing anything with those shorts. All right, come on, give me that. I can't believe I bought it. There we go, cracking that. Why did I buy this? I should have known better. Give me that panic. Give me that fear. $4. Trim. You can do this over and over and over again. And I'm going to hammer this home because this is so important. If I go here, I have to open this up, and I'm not going to have time to edit this. And I appreciate all your comments about not caring if they're edited. The price analysis series that I'm going to continue to do, they will be edited because it's going to be something that people can use over time. And I have somebody that's helping me edit them. But so what I'm doing here, I'm doing all these trades right around the same time on Friday, right? And they're all cracking at a specific time. I actually went long little Microsoft. It just didn't work on the starter. I'll show you that. And it was actually something that I wound up shorting. But if you look at these, they all happened at the same time. But all these levels were drawn out at the same time. They were all there. So if you go and take a look at Google, for example, and you look at this level, that level is already drawn. So when this happens, I already know that this is a place of interest. Someone could have easily just said, oh, okay, well, we're rejecting that place of interest. I'm shorting here. I'll use the high. I can't get over, and then it cracks. And you can do this over and over again. So if you look at Meta, for example, Meta goes back demarcation line, battleground. Remember, a battleground, somebody wins, somebody loses. And then you can see here again, somebody lost. This is over and over again. Even on Microsoft, if you take a look here, once we got back to that level, again, a demarcation line, what happened? So understand that once you have a specific pattern and process down, your life gets a lot easier because all of a sudden you're just waiting. And if it happens, it happens. You don't know you don't know the outcome, but you know that this is an area of interest. All right, let's get prepped for the week. We have a huge week ahead, and what I want to do is go through the top 5 names I think you should be watching for earnings. Not so much up or down, but where the battleground. So CVNA should be really interesting. There's a couple of reasons for that. You saw earlier that car manufacturing prices, the used cars, they're actually dropping as far as their pricing is dropping. And there's a couple things here going on. First, if interest rates drop, they should do better. So there's a chance that they could actually even raise guidance predicated upon that because we do know that they're going to cut rates. It's just a matter of fact. But there's a couple other things. In front of us is Manheim Used Vehicle Value Index, and this is a great way just to see what the value of their cars are doing. This is a way to understand the inventory because their inventory is how they make money. And you can see from 2020 on, inventory exploded. If you wanted like a Prius, it was like $100,000 or whatever. That's obviously hyperbole, but you get it. And what you're seeing now is with Mercedes coming out and they missed. You had Stellus, they came out, they missed. A lot of these car companies are coming out. Ford, worst day in a decade. They're talking about gross margins and people just don't have the money. You remember what we said earlier about CPI and the fact that they are just being priced out of the market, meaning the consumer. And it usually happens like that where you get an inflection point. It's not something that is like a gradient like that. It just hits a point where they can't spend anymore. But I just want to show you 23 through 24. And what you'll see here is that this was the pricing of vehicles from 23 to 24 on average. And you can see the drop in the pricing of vehicles. Now, they're turning over faster than 12 months, obviously. But what you're starting to see is these numbers are getting closer and closer together. In other words, they're dropping, yes. But then you have this little weird thing that happens right here. You see it go from 198, 197, 196, and then you're at 199.7. So what's happening here is that the pricing of used vehicles is dropping, and then it makes a little uptick. Now, this is important because a lot of times the inventory on wholesale will actually plummet before you see the market start to turn and they find a bottom. What's important about this is, while it might not be reflective in this quarter, it might be reflective in the next quarter. So they could actually come out and guide predicated upon this, which is kind of interesting. Now you could still see the difference year over year, but they don't hold their inventory that long. I'd be surprised if their inventory doesn't turn over every 45 days on average. I would have to look it up, but I would think it's something like that. So it's important to understand that while, yes, inventories are plummeting month over month, you just went up. So we'd want to watch this. Obviously, Wednesday are earnings. And the past two, we've just seen huge gap ups, and then they work it off. And what you're always doing with earnings plays is you want to look and see what do. They gap up, and then they work it off. They gap up, and then they work it off. So you already understand that there's probably not follow through. A matter of fact, if you go back, you really haven't had follow through except for, go back all the way to here to May 23. Other than that, every single gap up was just led by selling and backfilling. So it's pretty clear what's going to happen here or what has happened in the past. So this is something that you just be looking at for something like a short trade. Or a continuation trade if you were in earlier. Now, I know a lot of people don't look at this, but this is Mercedes, and you can see the gap down. Their gross margins were way off. And then you can actually see that here, and this is a company a lot of people don't really watch for a whole litany of reasons. But STLA, just think of some of the other brands that you know about, Maserati, Alfa Romeo, brands like that, and their gross margins were way off. And then you go look at Ford, which was just a dumpster fire floating down the river, right? Less the raccoons, but it was still awful. And then you look at how GM's acted on that news, and then you start thinking about, well, why did it act like that? Okay, because gross margins were off. So if gross margins are off and they're having issues, it really means that I would expect an extremely volatile CVNA. Now, the one thing that you always want to do with earnings, just so we're all on the same page, is I create a list every week, and then I will know the earnings of every single one, what the key issue is on the ones that I want to watch, and I'll have all my levels marked off beforehand. I would suggest that you take this tip and you do the same. That way you're prepared. Number two for me on the week is going to be Meta, and there's a couple reasons for this. This is where they instituted a dividend, and then after instituting that dividend, they said we're going to start giving money back to everybody. This is why pension funds would step in and buy that, because they know now that they're going to get a dividend. Pension funds and large pools of capital, really large pools of capital, like CalPERS pension funds or teachers' pension funds, they love dividends because they trade on assumptions, meaning if you're a pension fund, you're going on the assumption you're going to get somewhere between 5.5% to 8.5% a year. You go on that assumption, and then you're moving your equities and bonds based upon that. This is why Apple and Microsoft recently, if you look at the past decade, why they did so well. It was the dividend institution policy, and it was also their buyback policy. And we thought Meta was going to do that here. And then the next quarter, they come out saying, remember this policy here? Yep, we're not doing that. We're going to go and spend billions on AI. And so now you're at this situation where the stock's still up from that date, but right around that area where they invested before. This is kind of interesting. So this is going to have massive volatility, especially if you look at how Google was received, because the reason Google dropped after hours was the question, and it's always good to know what time the conference calls are if you're trading after hours. And why that's important is that once this one question was answered after hours, and you can see it right here on the chart, once they asked this question, that was it. It was over. Let's pull that up for a second so you can see it. And the question was simple, and that was the end of it. And she was very blunt about what it was, but right in here. And the question was, how are you going here? Or I'm sorry, it was right here. Apologies. How are you going forward with AI? What is AI actually contributing to for revenue? And the answer was for ad revenue. And the response was, that's it. There's nothing else that all these billions of dollars is doing but ad revenue. And the answer was no, at this time, that's all it's doing. I have my own belief. I don't believe that these hyperscalers, which is what these companies are called, remember Meta, Microsoft, that whole crew, they're 38% of CapEx of the entire S&P 500. So I personally think they don't care what they're spending. They're in control and they have so much cash. They need to be prepared for the future. And it's really like, do you want to race against a car with a buggy whip? And the answer is no, you don't. So I don't think that they care, and I don't know that that's going to help their stock price. But this is going to be extremely volatile. There's two things that really stick out to me about this. Number one, you're below the 55. It's been a long time since you started below the 55 for earnings. It's been a long, long time. You're going back to October that you've actually had no institutional support. So do they change their mind after the call and say, okay, we need exposure to it? Do the buybacks, which are kicking in next week, start after this call? Is that why this ran up last time? Because it dropped and then they had this huge buyback program? This is going to be massively volatile after, and you're going to want to listen to the conference call just like you would have on Google. A lot of moving parts to Meta. ARM is the third one. Now, these are the ones that I find most interesting. You might might find different ones that you find are most interesting. But if you take a look here and we look at Meta, we can see this huge break when everyone realized what was going to happen and that they were going to be really part of this new, like, let's call it mobile 2.0 AI movement. And that's really where this was going. And then we all kept thinking that SoftBank was going to blow out of their stake and everybody got nervous and then they sold. And then this really weird thing happens. They come out with earnings and it drops. And it never came back from that drop. If you look at last earnings, it never came back. Now, what's fascinating to me about that is if you draw this level right here, which was the gap up of last earnings, whoever was buying there is still buying. When it got close to that area again, guess what they're doing? They're still buying. So we're not seeing that selling pressure come in. Does that mean that we don't see it next quarter? No, it does not mean that. But you have this demarcation where these 3 bars or 3 days have controlled the entire trade. You popped out for a little bit, you're back in. If we overlay this and we could see that we are holding the 55 going into quarter, that leads me to believe that people from an institutional level, remember how I look at this, 22, do I want to swing it? Yes or no? Or I'm sorry, 12, do I want to swing it? Yes or no? 22, bulls are in charge, bears are in charge. 55, institutional support, yes or no. They're my 3 demarcation lines. You can use whatever you like, but use what you're comfortable with. But this is what I use. I'd watch how this is holding in here. I think that's fairly interesting. I am not crazy about the lower low, but if we drill into this a little bit more, you have to think about this. Are people going to want to play this one? You know, you have the lower low close, but look at that move. Did you ever really get there again? No, you just kind of flatlined. So this is something that you might want to watch earlier in the week and just see how it acts and go from there. But, you know, you could also just make the argument left shoulder, head, right shoulder, and it looks like a dumpster fire. And that's there too. But after hours, this is going to be wild, especially if they start talking about the future and how they're placing AI and the AI phones and the AI upgrades with Apple, etc. Apple's conference call will probably be the most important conference call that the company has had in a very long period of time. And the reason for that is the future. So you have every phone out there that will need to be upgraded if they're going to want AI capabilities. What they're going to have to explain on the call is why you would want this. For those that remember Microsoft, and when they did Office, you had this little paperclip that popped up and everyone thought that paperclip was going to make your life so easy. And that little guy just kind of went away. The question here is consumer AI. How much is really going to happen here? How important is consumer AI? They're going to have a lot of questions to answer. But I think that conference call could be mildly positive. That's kind of where my head is. I won't know until I hear it. Are people going to really care about the sales? I don't think so. Expectations here are really low for this quarter, really low for the quarter. It's going to be on future expectations and rollout and how they see AI developing. And I really think it's going to be the call. And I think that's what you want to pay attention to here. But this is definitely number 4. Number 5 is not Coin. It's not Amazon. It's Lam Research. And most people would look at this and go, of all the names, why would you look at this one? And it's pretty simple. We need to understand what's going on with the semiconductor capital equipment space. And I'm going to show you this. So if we go and take a look here at KLAC, KLAC absolutely crushed, knocked the cover off the ball, raised guidance, raised margins, beat earnings. It was an absolute utter blowout. But where you were in the food chain at that particular time, the stock sold down. This is what's so interesting to me, and it should be to you as well. Note what happened. You never went lower. That was it. And it's really important to get that. You keep gravitating towards that 55 over and over again. Remember, I used to 12 at 22 and 55. You should use what you're comfortable with. Why am I pointing that out? Because these names are being bought. Whether you think it or not, they are accumulating those names. Now, you might say, well, it doesn't look like that. Well, there's a big difference in accumulation stocks that are winners versus stocks that are just outright pigs, right? Like, nobody really wants AMD. No one's really clamoring to buy AMD's chips. You kind of have to buy that if you don't buy NVIDIA, right? But all this exists. That's a beautiful chart, maybe. But all this exists. Lam Research exists. If KLAC exists. If these companies don't exist, you don't make chips, whether you like AMD or you don't. But there's a reason why AMD got cut in half from the high and NVIDIA didn't, right? Demand. But none of it exists without KLAC, Lam Research, ASML, none of it. And so that's really important to remember. Remember what happened to ASML after last earnings and you came right back down to that trough level. These are major areas of interest. But Lam Research, as far as the top 5 for me, the last call was great. And I really think that this call could be something as well. And it didn't act well either. And I think that's pretty important. They're not acting well. What they're doing is they're trading up on expectations and then they're coming down. You're in the same area you were before. And it's important to note that KLAC was up $32 previous night before we came into all the shenanigans the next day. So I do have that on my list, and that's where I'm at. But you never know which ones are going to move, but they're the top 5 I'm focused on right now. That's it.